Today is Monday, January 24th, and I have the distinct pleasure of interviewing Andrew Simpson, Senior Vice President and Portfolio Manager with Mackenzie Investments. Andrew is a CFA charter holder and leads Mackenzie's newest sustainable investing boutique, aptly named Betterworld, which emphasizes best-in-class environmental, social, and corporate governance analysis. The team prioritizes companies with progressive ESG behaviors across both Canadian and global equity mandates. Andrew has more than 20 years of analytical and portfolio management experience, both in Canada and abroad. How are you today, Andrew?
Simon, I'm doing well. Pleased to be speaking with you today.
And it's great to be speaking with you as well. Would you be able to start our conversation by giving our listeners a brief definition of ESG investing?
Definitely. So incorporating environmental, social, and governance factors into the investment decision-making processes is really the broad explanation of ESG investing. How I look at that is, when you think about it, how companies treat the planet and the communities they operate in will determine their future profitability. Looking at ESG factors, I think, has really come into key mainstream table stakes here. So, for example, we look at the COVID-19 pandemic. It really brought attention to fragility of supply chains and labor markets. We saw systemic risks like climate change, social inequality, and racial justice really get highlighted during this period. So ESG investing assesses these risks. And what we want to do is assess the actions of the companies on how they address those.
And when advisors and clients use your funds, what do you think that they're looking for?
We really believe that investors are wanting to invest with us because they're looking for strategies that are going to align their portfolios with their values. So whether that is from a diversity and inclusion lens, or from an environmental lens, or a solid corporate governance lens, there's some studies out there. The Responsible Investment Association did a survey last year, and it said 77% of investors want to have a discussion about sustainable investing with their financial service provider, but only 27% are being asked. So I'm actually really pleased to be speaking with you today because you are in that group, Simon, and I think your clients see the importance of this investment strategy.
It's interesting. Right up until this morning, I've had people asking me about it. So it very much is current, and it is top of mind for a lot of people. When we are investing with an ESG mandate, thinking about shareholder engagement and active ownership, when we own corporations through your funds, we're actually owning a portion of the corporations, and we have rights attached to that ownership. We can go to annual meetings, we can engage with management, we can vote our shares and influence how that company does business. Are you active with the shares that you hold, and do you work with management, and do you vote your shares?
Absolutely, Simon. So advocacy and stewardship is a big part of our investment process. And, there's really three key drivers that we want to communicate to investors in our portfolios, because that aspect of having a right as a shareholder to engage on issues is really a sacrosanct view in our point. So one of the things we want to say is we want to be able to voice our values. So we want to use our rights to advocate for issues that are important for us as responsible investors. We want to be able to protect our portfolios from existing and emerging ESG risks. And, many of those don't show up in traditional financial statements. The work we do may identify issues that we want to speak to management with to find out how are they going to address these, what changes can they make. And lastly, it allows us to encourage companies to generate more impact. And can they align their businesses with the United Nations Sustainable Development Goals, for example? Those are key measures that we think are important for sustainability and improving quality of life. So having that interaction and dialogue with the management teams we own allows us to communicate our views and generate change in our portfolio.
When you are engaging with these companies, what kind of impacts do you realistically believe that you will have?
We think we can actually generate a significant positive impact with the companies we invest in. And so if you want to look at the risk side of things, if we think a company can improve their environmental management system assessments, it's all about looking at the company from a stakeholder perspective, actually. So, how that company treats the planet and the community they operate in is really key. You can look at increasing diversity on their board and senior management level as a way to make better decisions for the company going forward. We engage on a number of different areas. And so just to give you a highlight of what we're focused on for this year, for 2022, I'd highlight 3 points quickly. First is feeding the future. So, we've identified, along with the United Nations, that biodiversity loss is a major environmental risk that is being exacerbated by climate change. So we want to engage with our consumer staples companies and agricultural focused companies. How are they dealing with this issue that relates to their businesses? I mentioned diversity. So we're speaking with senior management teams on how their board compositions are going to broaden in the future, and the green energy transition. So we are a fossil fuel free fund, but we actually engage with the banks we own about their approach to fossil fuel lending, and if they will be reducing that, what is their accountability to meet the net zero commitments that they've announced, for example. So these are all areas where we can use our rights as shareholders to advance our interests.
To be devil's advocate here, the work you do engaging with companies takes energy and effort, and it costs money. An argument that I hear from many advisors that I know in our industry is that our job primarily is to help save our clients' retirement, not to save the planet. How much is that cost to the individual investor to do this advocacy work? And what benefits at the end of the day do you get from that expense?
Absolutely. So I think the investment in environmental social governance analysis really comes down to risk management and also seizing opportunities. So let's use an example from the financial crisis a few years ago. Wells Fargo is a company we used to invest in. We identified well ahead of the rating agencies that there were issues with a fake account scandal at that company. And so identifying a risk here and engaging with management to find out that there was not a quick transition to solving the scandal meant that we divested from the company actually about 4 weeks ahead of the rating agency. So we saved our investors a lot of money there. We think that identification of what is a risk in this case allows us to add value over a market cycle. And in our investment process, for example, controversies, they don't show up in financial statements. You can't do a DCF on a controversy. These are issues that you have to look at with your ESG team to say, is this a risk that we should be avoiding in our portfolio, for example. So in our composition of our team, actually 50% of our team is focused on ESG analysis and 50% on fundamental. And that's pretty unique in the industry. And I think it allows us to really position our portfolio for solid, sustainable growth going forward.
And you've kind of stolen a bit of my thunder on my next question, and that is, what aspects of your investment style, philosophy, or process do you feel are unique?
I think what's key in our approach, Simon, is really our philosophy that starts with the lens of a stakeholder. So we want to optimize our social environmental impacts and increase shareholder value. The way we can do that is looking for companies that balance the interest of the stakeholders. For us, that is the communities that the company operates in, the customers that they sell their products and services to, the employees that do the work, the environment that they operate in, because a company can obviously be impacted by the environment, and it can impact the environment itself. You have the traditional stakeholder of the shareholder, and then you have the suppliers. So are these inputs ethically sourced? So you put all that together, all of those stakeholders have a vested interest. So that's number one. Number two on our approach here really is that we put ESG first in our investment process. And we think by doing that, it really highlights that it's not a bolt-on. This is a core priority to our portfolio construction, and we're not outsourcing our work to third parties. That's really important as well. As I highlighted the team composition there, we're doing independent ESG work that identifies opportunities for us to invest over the longer term.
How long has your team been investing with an ESG mandate?
Simon, we've been investing for over a decade with leading with ESG in our investment process. We want to avoid companies that are unsustainable. We want to focus that capital on companies generating positive impact. And as we talked about earlier on, we want to advocate within that portfolio to add value from an engagement point of view.
And I know that this is already covered here based on your responses, but I'm going to ask this question anyway. Would you categorize your management style as an active management style or a passive management style?
We are active managers, Simon. We have a core large cap focus on our portfolios that lead with ESG analysis. That means we have fairly concentrated portfolios where we want to show our conviction in the names that we hold. When you're looking at our Canadian portfolio, for example, we're holding about 45 names, in our global portfolio about 65. That means we've done the work. We believe that these companies are going to be adding value over the longer term for our investors. And we want to actively monitor our holdings to ensure that if there are any risks present, that we're able to quickly deal with that and reduce risk for our investors.
My training, again, is coming from an investment standpoint, a make money for clients standpoint. It seems to me that there's a number of tailwinds in place for those that want to invest with an environmental mandate in mind. It's a huge trend that is happening right now. One of the things that this trend is being driven by is government spending. I'd like to ask a few questions to you, if that's okay. And that is, do you believe that governments will continue to focus on the environment? And how much do your expectations of government spending come into play? And finally, do you believe that governments will actually deliver on their spending promises, or are governments just giving a lot of lip service?
Governments are definitely going to have a role to play here, Simon, to guide the environmental dire situation the planet is in right now. So what we've heard over the last few years and kind of culminating in COP26 is the idea that we have to decarbonize. This is key. It's going to happen across every region in the world. Investors need to take this seriously and look at opportunities that can participate in this decarbonization strategy. So government regulation is going to be a part of that. We're looking for prices of carbon, for example, to rise in the future. So we want to invest in companies that have a very positive decarbonization position, for example. So the growth in renewables, as you highlighted, is going to be substantial over the next few decades. At this point in time, there is trillions of dollars to be invested in our electric grids, in our economies to move us towards that idea of a 1.5 degree warming limit. So yes, governments are going to have a big role to play. It's going to be through regulation. It will be through through incentives and subsidies. What's really important from our perspective, looking at capital markets, is which companies are going to be benefiting from these larger trends that are happening. That's where we think the opportunity is over the market cycle.
I know what you've done in the past, looking at your past numbers, which have been very, very good. But going forward, knowing that all equity investments will have periods of volatility, what sorts of long-term returns would make you feel like you did a good job?
We want to investors to feel comfortable that we are targeting competitive returns. I just touched on Morningstar statistic there that highlighted that sustainable investing strategies have been very competitive with traditional investing strategies. And I think the one thing I want to highlight here, we've touched on the environment being a key aspect of investment. I think we should chat, for example, on opportunities on the social side, and demographics of aging is an important aspect, for example, that we look in our portfolio where we think there are opportunities going forward. You look at the World Health Organization, for example, they're expecting the world's 60 plus population to double by 2030. So the ability to age in place, provide mobility to an elderly population. These are trends from a social perspective that we want to take advantage of as well. And that's why we think that a portfolio that looks at not just environment but social and governance aspects is really important to get a well-rounded, diversified return opportunity going forward.
Are there any other sectors or segments that you think people should be focusing on?
When I think of what is a great sustainable company, a surprising answer, for example, on the consumer staple side is Costco. So here's a company we own that we think is actually a great example of a company that pays its workers well, charges a fair price for the products that they sell. They're very, very stringent on the amount of profit that they'll take. They cap their margins. They are very much focused on advancing the employment opportunities for women in their workforce. And so that, for example, is for me a solid, stable company that is going to continue to exceed expectations and draw customer loyalty.
One of the exclusions that you have in your fund is nuclear, and there's a big push to have nuclear power be included as a green energy. Could you make any comments as to your feelings on nuclear energy and why that's been excluded from your fund?
We've excluded nuclear power from our portfolio from the current fact that the risks that are out there have not been addressed. We're still at a stage in the development where risks that are calculated at 100 years are happening every 25 to 30 years. There are innovations that are coming down the pipe that may change our view on a safer version of nuclear power. But right now, it's not investable. And so when we look at avoiding risks in the portfolio, nuclear remains an exclusion. You can just, for example, look at the Bill Gates book. For example, he speaks about small modular reactors as a safe alternative. So these are innovations that when they come into the market commercialized, we'll consider. But right now, it falls into a risk category for us, along with the other exclusions that we have in our portfolio: fossil fuels, tobacco, military, gambling, and pornography.
That's great. Thank you very much for those thoughts. Again, Andrew, thank you for coming out, and look forward to the next time we speak.
I did want to just leave with the point that the Betterworld funds are positioned as core portfolios for investors who want to align their investments with their values and achieve competitive returns. I will highlight again that they're fossil-free portfolios. We're investing in established best-in-class companies who recognize the importance of balancing the interests of their stakeholders. And we're investing in companies that are generating positive impact. And I think that's really key here to highlight that if by avoiding the negatives, focusing on positives, you can have a diversified portfolio that can add value from a financial perspective and from a values perspective.
Thank you very much, Andrew. Really appreciate you coming out, and I look forward to the next time we can have a conversation.